You go to deposit $10,000 from a car sale, an insurance payout, a family gift, and somebody tells you the IRS just set a new limit on your checking account this year. That is going around right now, and it is wrong. There is a $10,000 figure in federal law. It is real, and it has been on the books for decades. But it is not a limit on your account. It is not a tax, and it is not something you file. Here is what it actually is. The three things people get backwards about it, and the piece that matters most. The advice these warnings usually end with can turn a completely legal deposit into a federal crime. And there is one threshold that genuinely did move this year. It moved in your favor, and almost nobody is reporting that part. Let's start with what the rule actually says. Plainly, federal law requires financial institutions to report currency transactions over $10,000 conducted by or on behalf of one person, and also multiple currency transactions that add up to more than $10,000 in a single business day. Read that again with me, because every important word is in there. Currency. That means cash or coin. Over 10,000, not at, over. Conducted by one person, in one business day. And the part that changes everything, the financial institution reports it. Your bank fills out that form. You do not. There is nothing for you to file, nothing for you to sign, and no permission for you to ask. It is called a currency transaction report, and it comes out of the Bank Secrecy Act. This is not a 2026 invention. It is older than most people's mortgages. 4 things to hold on to. 1. It applies to currency, physical cash or coin. 2. The trigger is over $10,000, and same-day amounts can be added together. 3. It is measured per person, per business day. 4. And this is the one the warnings leave out. The bank files the report. You are not the filer, and you are not being accused of anything. So here are the 3 myths, and you can check each one against what we just read. Myth 1. It is a limit on how much you can keep in the account. It is not. There is no federal cap on your balance. You could hold that money for 30 years, and no report is triggered because nothing was transacted in cash. The trigger is a transaction, not a total. Myth 2. It applies to every kind of money moving. It does not. The rule we just read says currency. So think about what that word excludes. A wire transfer is not currency. Moving money between your own accounts is not currency. Your Social Security direct deposit is not currency. A check from a closing, a brokerage transfer, a pension payment, none of those are cash or coin walking through the door. If your daughter sends you $15,000 by wire for a roof, the cash rule we are talking about is not the rule in play. Now, banks do have a separate obligation to flag activity they consider suspicious, and that is a genuinely different rule with a different purpose and a different form. I am not telling you no other rule exists. I am telling you that the $10,000 figure being quoted at you in these videos is the cash one, and most of what these warnings describe is not cash. Myth 3. Getting reported means you did something wrong. A currency transaction report is routine paperwork on a lawful deposit. Selling a truck for cash is legal. Being reported for it is not an accusation, and here is what actually happens next in the overwhelming majority of cases. Nothing. Nobody calls you. No letter arrives. Your bank files a form. It files thousands of times a year, and your money is in your account. If you have been quietly afraid to deposit a legitimate lump sum because of something you saw online, that fear is the real cost here, and it is built on a misreading. Now the part I actually made this video for. These warnings almost always end with the same helpful sounding tip. Just keep each deposit under $10,000 and you'll stay off the radar. Do not do that. Breaking up cash to stay under the reporting threshold has its own name in federal law, structuring, and it is a crime on its own. The Treasury regulation defines it as conducting transactions in currency in any amount at one or more institutions on one or more days in any manner for the purpose of evading the reporting requirements. And the regulation says it plainly. That includes breaking down a single sum over $10,000 into smaller sums, including sums at or below $10,000. Read the IRS's own manual on it and you get the sentence that should end this whole conversation. Structuring is illegal, regardless of whether the funds are derived from legal or illegal activity. Your money can be perfectly clean. The splitting is the offense. So the free tip circulating in these videos does not protect you from anything. It is the one action in this entire subject that can actually put you in front of a federal prosecutor. I am not going to put a sentence length or a fine on the screen because I could not confirm those against an official page, and I do not guess with numbers. What I can tell you is the statute. Title 31, United States Code, Section 5324. In the regulation's own words, structuring is transacting currency in any amount, in any manner, for the purpose of evading the reporting requirements, and it expressly includes breaking a sum over $10,000 into pieces at or below $10,000. The IRS manual adds the line that matters most for an honest person. It is illegal regardless of whether the funds came from legal or illegal activity. Deposit your money the way it actually is. Let the bank do its paperwork. Here is what I promised you at the start. There is a real number that changed, and it went the opposite direction from the panic. For the last few years, you have been warned about a $600 rule. The idea that if payment apps or online marketplaces send you more than $600, you get a tax form. A lot of people over 65 sell things: a boat, a workshop full of tools, 40 years of a collection. That warning has been hanging over them. As of the IRS's own page, updated in June of this year, payment apps and online marketplaces are required to report on Form 1099-K when payments you receive for goods or services through the platform exceed $20,000 in more than 200 transactions. 20,000 and more than 200. Both. Not 600. For most people selling off a few things, that form is not coming. And now the two caveats from that same IRS page, because good news is only useful if it is complete. First, this threshold is for payment apps and online marketplaces. If you accept payment cards, there is no minimum reporting threshold on those. Second, and this is the important one, whether or not a form ever shows up, income from selling goods or services is reportable. The threshold decides who mails you paperwork. It does not decide what you owe. Put those two sentences together, and you get the practical rule. Say you paid $2,000 for a dining set in 1998, and you sell it now for $400. You sold it for less than you paid. There is no gain there to tax. Now say you buy tools at estate sales and resell them at a profit through an app all year. That is income, whether the platform sends a form or not. Same app, same threshold, completely different answer. And the thing that decides it is what you paid, which brings us to the one piece of homework in this video. So what does this add up to on a normal Tuesday? If you are depositing cash, deposit the whole amount at once and answer your bank's questions honestly. That is the entire strategy, and it is free. If a teller asks where the money came from, that is them doing their job, not building a case. And I sold my truck is a complete answer. If somebody at a car sale or an estate sale suggests you take the payment in 2 trips to keep it tidy, that is the exact thing we just talked about, and the answer is no. If you are selling things through an app, keep your own record of what you paid and what you sold it for. A note in a spreadsheet, a shoebox of receipts, a line in a notebook. The format does not matter. Having it does. That record is what separates a loss on your old dining set from taxable income, and no platform is going to reconstruct it for you years later. And here is the habit worth more than any of it. When a video tells you a federal agency quietly changed something and you have until the end of the month to act, notice that shape. A named agency, a vague change, and a deadline close enough to make you hurry. That combination is doing a job, and the job is not informing you. Before you move a dollar, put the claim into the agency's own site, irs.gov, finson.gov, ssa.gov, and see whether the page says what the video said. Every number in this one came off a page like that, and all of them are linked below so you can check my work. 4 things. Deposit cash in full. Never split it to stay under a number. Answer your bank plainly. Keep your own purchase records for anything you resell. And before you act on any new rule you heard about, read it on the agency's own site. Here is the short version. Nobody set a new limit on your bank account this year. The $10,000 figure is a cash reporting duty that falls on your bank, not on you, and it has been there for decades. The advice to slip underneath it is the only genuinely dangerous thing in the whole subject. And the threshold that actually did move this year moved up, in your favor, and mostly went unmentioned. This channel is educational. It is not personal financial advice, and it is not tax advice. Your situation can turn on details I cannot see from here, and a large or unusual transaction is worth 10 minutes with a CPA. What I can do is show you the published rule and where it lives, and every source is linked in the description so you can read it with your own eyes. Check the rule, not the slogan.